All right. Welcome, everybody. If you can hear me, please drop a 1 in the chat. That'd be super helpful. Welcome, guys. Welcome. We'll give it just a few moments to make sure people have time to join. And while we're waiting, let me know where you're tuning in from. That'd be super cool to see. Trading Prodigy is part of TraderLion. It basically gives you early access to the interviews that I do, but it's not required for to join today's webinar. This is completely free. All right, New Orleans. Hey, Jay. Good to see you guys. A lot of familiar faces already, so awesome to see. Hey, Eaton. Hey, Chuck. Good to see you. Very nice. Welcome. Good morning, guys. Good morning. Hey, James, John, Cecile. Very nice. All right, let's see. Maine, Shoreline, Washington. Very nice. Good morning, guys. Good morning. Alabama, Florida. Very nice. Good morning, guys. Good morning. We'll give it 1 minute or so to make sure people have time to join here. And let me know if you can see my screen and my cursor as well. All right. All right. Somebody's on the ice shelf of Antarctica. Cool. All right, cool. Perfect, guys. Thank you so much. Good morning. Yeah, sure. So Trading Prodigy, I see somebody asked it. It basically is a YouTube membership that allows you early access to watch the podcasts I do with top traders, and you get to watch with no ads as well. So that's the main benefit of the membership. You also get to request questions, and I'll give you a heads up whenever I'm doing a new interview with a U.S. investing champion, top trader, hedge fund manager, market wizard like Stan Weinstein. You'll be able to basically request questions as well as watch that interview a little bit before everybody else. But it's not required to watch these Traders Handbook webinars. All right. We'll take a look at the Kindle version. We'll see if there's an issue there. Himanshu, thank you for letting us know. We'll take a look. The previous webinars are archived on our YouTube page. I'm making a playlist that is Traders Handbook webinars. You can go to TraderLion.com or YouTube.com/TraderLion and find that playlist. We'll also be posting the recording from last week's today, so you can stay on the lookout to that. And I'll be linking the entire playlist in the description of that video. All right. Okay. All right, guys. So welcome everybody to the next Traders Handbook webinar. Today is going to be a really important one and a really good one as well, discussing sell rules and position management. You know, previously we've talked about risk management itself, which is kind of about starting a trade, how to actually manage risk with your initial stop loss, how to move up that stop loss. Today we're going to be talking about if you have a profit, how do you manage it properly to make sure you're taking profit when you need to, but also letting it run so that you can let asymmetry work in your favor. So this is going to be a really good one, and hopefully you guys are excited. And let me know right now in the chat and in the comments what questions you have about sell rules, position management. You can get really specific. You know, do you want to focus more on selling into strength, selling into weakness? What confusion do you have there? Let me know in the chat as well as in the comments below. And while you guys are doing that, just a quick reminder to join the Traders Handbook waitlist. This gives you early access to a lot of resources that we're releasing along with the book here, which will be out on May 27th. And basically, by joining this waitlist, you get extra bonus articles, you get early access to these webinars and to register for them, and a whole lot of other bonuses that are still to be named, as well as exclusive giveaways. Here's a little bit about the articles that we've been sending out. This weekend, I'll be sending out the stop loss setting guide, as well as the sell rules checklist, which will be really helpful for you guys. So definitely go ahead and register. Again, you can scan this QR code right here and join if you are not already on the list. With that said, welcome everybody to the next Traders Handbook webinar. Today, as I mentioned, will be focused on sell rules and position management. This goes along with Chapter 7 of the Trader's Handbook, which will be released pretty soon in May. So make sure to grab your copy if you haven't already. And let me know right now in the chat if you've already purchased and got your copy. And I heard from a few folks who actually bought multiple, one for the office, one for the home, which is awesome. So definitely go ahead and make sure to grab yours. The link to that is in the description, and you can check that out right now. All right. So I want to start with a quote that we saw in the previous webinar, but it still applies to sell rules and position management. And, this is from William O'Neill, the founder of Can Slim. Buying a stock without knowing when or why you should sell is like buying a car with no brakes, or being in a boat with no life preservers, or taking flying lessons that teach you how to take off but not know how to land. And I think this is really, really important, especially in these current market conditions where things are more volatile, things are moving faster than they used to, because, I think a lot of traders are almost surprised when they have a great winning stock that actually worked for them out of a strong breakout. And if you don't manage a stock like that correctly, a trade like that correctly, you can choke it off and, leave a lot of profits on the table. So we'll be talking about concrete rules that allow you to stick with the trend today and hopefully get the most out of those trades that really work out and really move the needle in our accounts. So here's the agenda for today. This is going to be a really good one. First, discussing sell rules based on time frames, style, experience level as well. We'll be definitely getting into the weeds of selling into strength versus selling into weakness, with multiple case study examples for both of those, showing how to actually apply it and what price and volume characteristics to look out for. They'll discuss a little bit about trading around a core position, key takeaways, as well as discussing some kind of special situations, handling earnings reports, large gaps, end of day stops. All of these are important questions that I think you have to answer for yourself as a trader to build your trading system, which is the goal of both the Trader's Handbook as well as these webinars to help you do that concretely. And let's go ahead and dive right in. So these are some questions that you might be asking yourself related to position management. How do you define what is extended? How do you know when to sell into strength? When should I sell? How much should I sell? What if it goes up after I sell? When do I take profit? How do I manage a position through earnings? These are all questions that we'll answer in today's webinar and are basically really essential to answer for yourself, again, to build your trading system and build your sell rules as a trader. All right, let me take a quick sip of water here. So what is position management? Position management is basically a system for managing a stock when you are at a profit to ride the trend relevant to your style and time frame. This is a really important last bit of the sentence. It's not about capturing, buying the low and selling the absolute high. It's about capturing the meat within that trend that's relevant for you and your style. If you're a swing trader, it's going to be that first momentum burst. If you're a position trader, it might be, catching the whole trend, but then, selling it off the top because it's breaking down. But again, it's about the trend relevant to your style, your time frame, and your objectives. And it incorporates both sell rules for taking profits into strength and or into weakness, depending on your style. You might be doing more selling into strength versus selling into weakness. And I think this is really important. People say winners manage themselves, but that's not really the case. You have to handle a big winner properly to get the most out of that. And we'll be providing concrete rules to help you do that and provide guidelines and foundations that have helped for us and will likely help you as well. And I think this is a really important point as well, is that clarity around your sell rules reduces confusion and noise and allows you to execute like a professional. I think a lot of people, get a winning trade and are confused about their objectives. They're a swing trader, but they suddenly have this 40% gain and they don't know if they should take profit or should, keep holding and see if it can double or triple from there. And this confusion leads to a lot of emotions. It leads to a lot of, lack of clarity. And you need rules to help you understand those situations, what exactly you should do relevant to your goals and objectives. So these sell rules that we'll be discussing today will give you that clear foundation and help you limit the impact of those emotions on your trading. And I think this is really important as well. The goal is asymmetry. Keeping losses small is accomplished through stop losses, through the risk management webinar and chapter that we talked about, this previous Wednesday, which you can find the recording link down below. And letting winners run is defined by the sell rules we'll be discussing today. And this is kind of a very, representative graphic here that I quickly put together. You've got your entry, it broke out, formed some higher lows. We've got some sells into strength. You could also sell some into strength here or here, but then we start to see a break of structure, a lower high form, and then the stock really breaks down through previous higher lows. And this is where you'd be selling into weakness. So sell into strength is basically selling as the stock is going up, as we'll get into much later on. And selling into weakness is as the stock is breaking down through your definition of trend and starting a downtrend once you were previously in that uptrend. All right. I want to start with this because I think it's a really important point and something that William O'Neill emphasized a whole lot to Ross Haber, who of course is a co-founder of TraderLion. He's taught me quite a bit about trading, managing trades on a technical basis. He really emphasized that we buy based on both fundamental and technical analysis, investigating the story of the stock, the great products it's producing, the earnings growth, the sales growth, the news catalysts that are around the stock. However, he really emphasized this. We manage a position solely based on price action. We're only looking at the price and volume action to decide, should this be a sell? Should this, be a hold? Should I wait for more information? That's really key. And the reason for this is because price action at the end of the day is what determines our profit. You've heard Brian Shannon say only price pays. It's completely true. And there's so much news events, so much noise about the market, the Fed, the individual stock going on, that it's very hard to interpret everything to the best of your ability. And the way to go about this and to resolve that is price action at the end of the day is taking into account all those different inputs, the market health, what the Fed's doing, macro events, news catalysts, all of this is taken into account and is revealed how the institutions which move the stock over the long term are interpreting that information in the price and volume action of the stock. So that is why we solely, decide sell decisions based on the price and volume action. And here's a good quote from Jesse Livermore about kind of, identifying and interpreting news events. The reason for what a certain stock does today may not be known for 2 or 3 days or weeks or months, but what the dickens does that matter? Your business with the tape is now, not tomorrow. The reason can wait, but you must act instantly or be left. And I love this quote because he uses the phrase, what the dickens. I think we should bring that back. Hashtag what the dickens. But I think it's so true. You want to manage risk in real time, deal with the information you have on the table right now. And I think that's so important. So this is a really good quote to internalize as you're thinking about creating your sell rules and position management rules. All right. So sell rules based on style. So we'll go into kind of what a swing trader and position trader, what they are, how they should be thinking about sell rules. But first things first, in the chat right now, hashtag what the dickens. Perfect, Joho. First things first, in the chat right now, put if you're more leaning towards a swing trader or position trader. I'll be really curious to see what the results are here. So let me know if you're more leaning swing trader or position trader. I personally would put myself kind of as a hybrid, somewhere in the middle. I like to lean into which way the market is favoring. So we see a lot of swing traders, both position traders, Okay, so a good mix of everything. Perfect. Yeah, I would put myself in the middle here, a little bit of a hybrid approach, and I'll kind of talk through my exact sell rules and what I do during the examples later on. But a swing trader, your objective is to trade the momentum moves and to sell into those moves and sell into the volatility to the upside or downside if you're shorting. And you're going to be biased towards selling into strength. And the reason you're going to be doing that is based on multiple reasons, but you're trying to exit at equity highs. You're trying to just capture the short bursts and move on to the next setup, the next stock that's coiled or meets your particular setup. You don't care about what the stock does after you sell into strength. It could go, and double, triple, and it doesn't matter for your system because your system is to rotate to the next setup, to the next great opportunity, and to just kind of churn over your edge and make progress that way. The position trader is a little bit different. You're not really focused on, you are focused on capturing the momentum moves, especially at the beginning after your entry, but you're more trying to find, duration trades, trading longer term trends where a stock is trending for weeks, months, even a year and a half or more, ideally. And you're biased more towards sticking with that trend until it really breaks down. That doesn't mean that position traders can't sell into strength. You definitely can. And we'll talk about, some sell rules for position traders in just a bit. But you more want to focus on building in asymmetry by capturing as much of that trend as possible. And there's also another really good Livermore quote that I think is relevant here, where he talks about, the first and last eighth are the most expensive ace, of a profit. And with a position trader, you're really trying to catch early on in the trend after maybe the first eighth is done, capture the meat, and then maybe, sell some into strength here and, just capture 7/8 as it pulls back to that prior level. While a swing trader, you're really just trying to focus on capturing one or two of those eighths during a trend, during the most powerful periods of that move. So I think that's another good way to think about sell rules based on either being a swing trader or a position trader. And I also want to bring up here and revisit a concept that we talked about way back in one of the early webinars here, the stage you're in and how that impacts your sell rules. And today we'll be giving kind of really concrete sell rules for stage 1, 2 traders. Stage 3 and 4 traders, should build on the foundation and the techniques that they build in stage 1 and 2 and come up more with sell rules that allow them to perform, allow them to personally tweak towards their style, how they like to do things. While stage 1 and 2 traders, it's more about just building consistency, having a system in the first place, because that's a big problem with stage 1 and 2 traders is in the first place, they don't have sell rules. They get a profit and they have no idea what to do. So we'll be talking about really concrete rules for stage 1 and 2, and stage 3 and 4 traders will be giving some recommendations and tweaks that they can do to optimize for their style swing versus position trading. So again, in the chat here, let me know based on these characteristics and based on what we talked about before, what stage do you feel like you're personally in based on these graphics here and these kind of characteristics. And let me know. You can also be in between a stage. You can say stage 2 plus, and that's kind of in between stage 2 and stage 3. Probably many of you guys are stage 2 plus or stage 3 plus, I would imagine. All right, we've got stage 2, stage 2.5, perfect. Stage 2, 1.5, 2, very nice. So we've got a good mix of people, a lot of stage 2s, which is perfect. That's exactly the demographic we're trying to help out here. Steve, hey, how's it going, Steve? Good to see you. Stage 3 to 4, perfect. Stage 2 plus, stage 3.14, nice, Alberto. All right, perfect. All right, so we got a good mix here, which is great. So sell rules for stage 1, 2, focusing in on that subset. So if this is you, really pay attention here. Again, at this point, you're just starting out in your trading journey. You're trying to establish a system for the very first time. And your goal is not to perform. It's not to go out and make triple digits like US investing champions that have been trading for 7, 10, 20, 30 years. Your goal is to actually build a system that protects you and allows you to build techniques that will help you in your future stage 3 and stage 4 periods later down the road. So again, the major goal is consistency and building sound habits, building technique that will help you later on in your career. So for these traders, and these rules may feel constricting, but that's really the point for stage 1 and stage 2 traders who are experiencing a negative equity curve, not a lot of confidence, not a lot of success. That's the reason why these are so strict, is because we're trying to help these stage 1 traders stop the losses and allow them to participate in the winners. So the first sell rule for these folks is to sell at 5% profit, sell half of your position and move your stop up to break even. So that's very simple, very easy to do. And that's a lot about this. The rules we're trying to bring here is keep it simple, because keep it simple means that it's going to be a robust system and not be overfitted to one period where everything's working really well, trending well, while another period where it's a pop and chop type market where nothing's working. So we want to build a robust set of rules that helps us survive all those trading environments. So again, the first sell rule for these folks in stage 1 really, and then also stage 2 is at 5% profit, sell half and move up your stop to break even. Sell rule tool is kind of divided in two based on whether you want to be a swing trader or a position trader. And for swing traders, sell the last half on 2 closes below the 21 EMA. For position traders, it's basically the same exact thing, except instead of the 21 EMA, you're looking to sell on 2 closes below the 50 SMA. So again, if you want to be a swing trader, use this one. If you want to be a position trader, use this one. And these are guidelines. And of course, you want to adapt it to your own personal situation. And it doesn't really matter if you use the 21 EMA versus the 21 SMA versus the 20 SMA. Pick what you find helpful to you and, adapt these rules to what you find to be very, very helpful. All right. let's see. So here's an example of an application of this rule set for VST. You bought through the consolidation pivot here. You manage risk at the low of the day here as it reconfirmed through the prior day high, as well as this key level. And your first sell is very simple. Up 5%, you sell 50% of your position. So remaining, you have 50% to ride that prior trend. The 21 EMA, which is this line right here, has moved up through your costs, so you're doing well. And the stock really shoots up, trends beautifully, and you ended up selling with 2 closes below the 21 EMA for a swing trader. You sell the last bit of your position, sell 50%. Remaining, you have 0%, and the result is a really nice gain of just under 20%. If you were a position trader instead, again, you would have sold your first sell right here of 5%, but you would have gotten a little bit more of a profit and end up being a net result of up 31%. I think this was up about 50, a little bit 50% here. You've got around 83 all the way up to 135 or so. So really nice solid gain, and you get a net result of 31.5%. And I want to pause here and talk a little bit about just for a moment about the pros and cons of swing trading and position trading, because really they can be both extremely successful. You see US investing champions with both styles. However, swing traders are going to be dealing more in the momentum moves, and there's a little bit more potential because once a momentum move ends, they can move on to the next one. While position traders, there is maybe the potential for some opportunity cost based on staying with the stock that's already made a really nice move and is just kind of building a base. There is some time loss there where your money could be working somewhere else. However, on the flip side, a swing trader is never going to catch a 300, 400% move unless they have a rule where if they have a certain amount of profit cushion, then they switch over to more position type trading rules. But a position trader could have, a lot less trades and have extremely great success if they find the true market leaders and enter those stocks and participate during those longer moves. So there's pros and cons for both of these. And for position traders, this I think is better suited towards traders who are doing this part-time. They have a full-time job. There's less action they need to take, and it's a little bit calmer as well. You can look more at weekly charts, while swing traders, it's a little bit more maverick. You've got to kind of keep rotating your money to turn over your edge. So that's a little bit on the differences and pros and cons versus swing trading and position trading. And I think with that said, you can kind of adopt a hybrid approach, which is kind of what I've done to get a little bit of the benefits of both, depending on the market environment and the situation. And we'll talk about that in the rest of the webinar. All right. So these were the basic sell rules. Again, sell your first 50% of your position of 5%, and then depending on swing trading versus position trading, sell on 2 closes below the relevant moving average. There are some progressions as you gain more comfortable. You're more solidly in stage 2. You feel like you're stage 2 plus. So this is you. Listen up. This is the time to pay attention. The first progression, and I do want to emphasize here to not rush this process, especially if you're very early in stage 1. It's going to take time to really internalize these rules. And just this basic rule set can do extremely well during trending environments and when growth stocks are working. So don't feel like this is, putting on training wheels. This can do extremely well and will also protect you when the market isn't quite as strong. But these are some progressions that you can adopt if you feel like you want to make advancements, and these are potential tweaks to your existing process. If you've got your own existing sell rules, these are some ideas for you to maybe adopt to tweak and improve them over time if you find them helpful. So first, instead of selling half of your position at 5%, instead do a third and sell the next third at your average gain over the last 20 trades. And then sell the last third on the normal 2 closes below the moving averages. So instead of selling half at 5%, you sell a third, another third at your average gain, and then the last third on in weakness using the moving averages. The next progression is to sell a third at 5%, a third into strength as the stock gets extended above your average gain and gets, as I say here, gets visually extended from a moving average. And we'll talk about different ways to determine extension later on in today's webinar, and then sell the last third on weakness using the same moving averages. The next progression is to use the rule above, but allow yourself to add back a third if the stock forms another low risk entry tactic. So again, this is a little bit more advanced. It's about trading around a core position and re-entering a stock if there's another low risk setup against a moving average, a new base forms and then sets up again. You can add back a third that you sold prior. And then the last progression is to, again, sell a third at your average gain. So you're no longer using that 5%. You're looking to hold a little bit longer, a third into strength, and then a third into weakness using the moving averages. But you can also add back up to 2/3 of what you sold if the stock forms another low risk buy point. So let's go through an example, that same example of VST, applying these different rule variations. So let me get a sip of water here. All right. So again, this is the same VST trade. You're using the same entry tactic and buy point here. And this is the first variation where instead of selling 50%, you're selling a third at 5%, a third at your average gain, and a third at 2 closes below the MA. So here is your initial sell of 5%. You've got remaining 66% instead of 50%. Your sell 2 is at your average gain, which we used in this case, an average of 10% gain. You sell 33%, and you've got remaining 33%. Then the stock trends, and you've got your normal sell rules below the moving averages for swing traders down here and position traders up here. And you might note that this actually performs worse than the first rule set that we talked about. But again, this might be a little bit more dynamic and might feel more comfortable for swing traders, especially to sell a little bit more. And then you can rotate that capital to another opportunity versus being stuck into a stock as it's trending above the 21 EMA and waiting for that last bit to sell before you can move on. So this is a rule progression that you can adopt. Maybe you prefer the first set, go with that, figure out what works best for you and use those sell rules. Here is the second variation where you're selling on the extension instead of at your average gain. So again, your first sell is up 5%, move your stop to break even. That protects you. Then you've got an extension here, a gap up and strong move. You didn't sell at the high of this day. You sold as it was pushing higher and really becoming extended with a gap here. And then you've got your last sell again under the moving averages. Swing traders again taken out here. Position traders get taken out here, and you have, again, pretty strong gains here, about 20% and about 27%. So performs better in this case than the prior variation. And again, it's not about individual trades and how these rule sets work on, an individual trade and individual stock. It's about how they work over time and how they fit your personality, how much risk you like to take, how much drawdown you like to experience. Because if you don't like experiencing drawdowns, you want to sell more into strength, more as the stock is going up and making momentum moves, and just letting a trailing piece on for a bigger move. So it's all about fitting these rule sets and figuring out what works best for how you view the markets and how you experience risk and your own personal risk tolerance. Here's variation 3, where you can add back 33%. And here's the add back point here as it formed a new base and undercut and reclaimed the 2021 EMA and broke out of this base here. For a swing trader, you actually sold out of your whole position before that, but you added back 33% because that's in your rule set. You're able to do that. And you ended up selling that for a 23% gain here as it broke down back below 21 EMA, a little bit higher. You've got a 23% gain instead of about a 20% gain. And for a position trader, you actually added back here. And your overall net is a 31% gain. So you sold 33% up 59%, and that last 33% that you added back, that you sold back here at 5%, and added back here as well. So you've got a little bit better of a gain. So again, this allows you to trade around the core a little bit more. And this next variation allows you to re-enter 2/3. So you've got your swing trader here up 29% now, and you're able to stick with that trend a little bit more. And position trader just gets a little bit more juice and a 35% gain because they were able to add back on the next low risk buy point a little bit more and trade around that core position. So those are the 4 variations. Again, here is basically the definitions of them. And in the chat right now, let me know which kind of rule set or variation kind of appeals most to you. And again, it's going to be dependent on your situation if you like to sell more to strength versus weakness, and also again where you are in your trading journey. If you're more advanced, you're likely not selling half at 5%. Maybe you're selling half at your average gain, half into as an extension, holding the rest for the 21 EMA. But let me know in the chat which variation kind of makes the most sense to you and how you like to personally trade. All right. Jay Patel says number 2, 1 to 2, and fast number 4. So we've got a mix. Again, everybody's going to think a little bit differently, and different rule sets are going to appeal better to different situations and different types of traders. But again, these are just examples as well of tweaks you can make. Maybe you're not going to adapt exactly variation 4, but you might tweak it to how you like to trade and your personal sell rules. Now for stage 3+ traders, the goal is different. Again, the goal for stage 1 and 2 is all about building consistency, establishing an initial system to actually test out who you are as a trader. Stage 3 and stage 4 is more about performance and actually performing really, really well. And sell rules will adapt to the character of the stock and the actual market environment. Maybe the market environment is rewarding, strong trending markets, holding onto positions longer. You adapt a little bit more and lean more into selling into weakness versus selling into strength. And sell rules are tailored to the trader's biases, selling into strength or weakness, again, based on their personal way of interpreting the markets. And instead of rule 1, which is sell at 5%, you can sell at extensions as your first sell instead of fixed levels. So you get a little bit more variability in your sells, but it might lead to increased performance over time. And instead of sell rule 2, which is breaks below 2 moving averages, you could divide sells between the 21 EMA and the 50 SMA to hold a little bit longer. And you can use judgment on the negativity of the 2 close below a moving average. And what I mean by that is, let's go to this this example actually right here. So this first close below the 50 SMA is very negative, but the next close is higher than this bar right here. And let me zoom in here to actually really show this. So this first close below the 50 SMA is very negative, closing at lows, big range bar, but the next day is an inside bar that closes higher than this close. If you want to be, if you're more of a stage 3, stage 4 type trader, this might not trigger your sell rule as 2 closes below the 50 SMA because this close is more positive than this close right here. And that allows you to stick with that trend and, stick with it. This low is never lost. That could be your rule. If it breaks below this low, that's your sell rule. And you hold on, and this one rallied and kept on going. So that might keep you in a little bit longer in certain situations when a stock is very strong. So that's kind of a nuance or variation that you can adopt if you would like to as a stage 3 or 4 trader. So those are some ideas for the more advanced traders out there about how to adapt their sell rules to be a little bit more malleable. And you can do that as a stage 3, stage 4 type trader. But again, stage 1 and 2 is about rigidity, system, consistency. Stage 3 and 4 is about performance, and there's a little bit more discretion and variability allowed for those type of traders. All right. So here's a stage 3 example, maybe how you would apply this as a stage 3 trader. These are similar to my personal sell rules. So you've got that same entry point. Your first sell isn't at 5%. It's at this first extension up 20%. You've got still, and you're not selling a third, you're selling only 25%, looking to hold the majority for a bigger move. You've got another sell on another extension. You sell 25% of 54%. You've got 50% remaining. And your last sell as a swing trader is 2 closes below the 21 EMA. You sell 50%, up 34%. So you get a nice trade overall. And your rules allow you to re-enter 100%. Or if you still have a full position, add 25% back. So here on this next lowest buy point, you re-enter. And your final sell as a swing trader is 2 closes below the 21 EMA. With that last trade netting another 12.7%. So instead of about a 20% gain, which we talked about with the previous variations for earlier stage traders, you have almost a 50% gain. And that's where the performance really comes from, is waiting for those key points, this extension, this key reversal bar extension, and being able to add back and start a new trade within that same longer term trend, a new swing trade when we get a reinvigorated momentum move. And even looking at this example, a stage 3, 4 trader might not be waiting for 2 closes below the 21 EMA in this case, because look at this bar. We break all these lows altogether, this lows as well. So you might have actually raised your stop to this element in structure and, improved the second trade here and gotten a little bit more juice and performance out of the second trade. Again, just adding to your overall profit. For a position trader mindset, again, maybe you sold one here into the extension, sold again here, and then you add back here and you're selling, the 25% position up 10% here, and overall get a 61% gain. So both of these situations, this shows how a stage 3 type rule set, which is a little bit more adaptive, a little bit more discretionary, a little bit up to the personality of the individual stock, can allow you to perform better, but This is only available for stage 3 and 4 traders who have proved themselves to be able to manage risk. They've built that technique over time and use that rigidity that they learned in stage 1 and 2 to allow them to be a little bit more creative in stage 3 and 4 to perform a little bit better. So this is an example of how to apply a little bit more of a fluid rule set that adapts to the personal situation. And this is pretty similar to my personal trading rule set as well. All right. So a little bit more on market environment and sell rules. Different market environments will favor quicker rules and put more emphasis on selling into strength or weakness. And this is a really important point because I think a lot of people get worked up about, there's a 2024, 2020, and they look back over their trades and they're like, wow, if I just hold until the stock breaks the 50 SMA or 100 SMA, I'm going to make 300% every single time. I sold way too early. But the reality is that not every year is like a 2020 or 2024. And the rules that would have worked really well in 2020 or 2024 are actually overfitted to that market environment that was extremely good and not going to happen every single year. And so when they adopt those rules that, to hold on to a stock until it breaks the 50, no matter what, the next year is choppier. Breakouts aren't falling through nearly as much. And instead of getting those 300%, 400% winners, they get stopped out a lot. They hold on too long to their losers, to their winners as they're pulling back, way back into the moving averages. And they just don't perform using that rule set, which was supposed to be the secret sauce and perform really well. But the reason being that it didn't is because the market environment is not always conducive towards longer term, more position trading sell rules. So you want to remember that as you're looking back on your trades and deciding what rule sets to use, is you want to avoid overfitting and think about a rule set that is robust, that will adapt to different market environments, both really great trending ones as well as choppier ones, and protect you in those situations. And just be aware that a rule set that worked really well in a strong trending market environment may perform horribly in a very choppy, up and down volatile market. So that's something really important to remember. And a way to help you identify if you're in a trending or choppy environment that can be an input to allow you to switch rule sets or just be more aware is you can track your average gain over the last end trades. This could be 20, this could be 50, this could be 30, this could be 10. And if your average gain is increasing or decreasing, that can help tell you, are we trending or are we more choppy? If it's increasing, it's more likely to be a trending market environment where longer term sell rules may do better. But if it's decreasing, you might want to tighten things up because it is a little bit choppier. And also, I just want to point out that, this is pretty obvious, but is worth mentioning as well. Stronger markets after significant corrections as bear markets will favor those longer term rules. So you might want to lean more into, the position trading type mindset after a significant bear market or correction, like after COVID, after the 2023 bottom. That's when the long trends really happened. That's where we saw PLTR, NVIDIA start their 1,000% moves that would have held up really well with longer term sell rules. So keep that in mind as you go through it. And also, I want to mention here, when a market trend goes sour, it often happens fast, and growth names will all kind of drop in tandem altogether. So you want to be aware of that and act fast and manage risk in real time. And also you can track the leaders carefully. And if they are breaking down, be on guard for more weakness, and that can help you inform you about the market environment and how you should be managing your positions. So this is just an important slide to think about how the market environment will impact which sell rules are, working well in that current market cycle. All right. So we'll take a quick Q&A break. So drop your questions in the chat here, and we'll go ahead and answer a few questions. Also, this is the QR code that you can use to order the Trader's Handbook. If you find these webinars helpful, you'll definitely enjoy this Trader's Handbook. Everything we talk about here, we talk about at length in this book as well. And the last chapter, chapter 12, is a model book of the greatest winning stocks over the past decade. And it's great study material to help you speed up your learning curve and study those winners to distill the concepts that we're talking about in these webinars. So definitely go ahead and order yours if you haven't already. And let's go ahead and see if there's any questions here. All right. Let's see. Yafal, make sure you're watching in full HD. You can change that setting on your end. Should the initial sell depend on what your initial stop is? It can, if that's your rule. You could sell at 3R, 2R instead of that average gain or 5% rule. But for stage 1, 2 traders, we're just using a very simple and effective 5%. But if you're more stage 2 plus, stage 3, you can say, I'm going to sell at 2 risk multiples or 3 risk multiples. And that's how you can define your initial sell number 1. Clarify extension, we're going to get into that very shortly. So great question. Does the same apply for short selling rules? I would say short selling rules are the same on the flip side, but you want to be faster and lean more in terms of selling into strength for short selling rules, just because the moves are faster. The moves up from the moves up after a strong extension down are more vicious. So you want to lean more in terms of selling to strength, which means, selling into weakness if you're, covering into weakness if you're shorting. So you just want to be a little bit faster when shorting as well. Hard stop versus mental stop. We'll talk about that at the very end. And we'll dive right in because a lot of people are talking about extensions. So let's discuss more. Actually, first I want to talk a little bit about this. Let me get a sip of water here. So this is more for the position traders out there. So pay attention if that's you. Tips for holding big winners longer and getting the most out of them. Because I think a lot of people would have much better performance if they kind of got out of their own heads, and when they have a big winner at 40% plus, actually let it work and let it trend for them instead of time choking it off and micromanaging it. So first things first, the best trades that really contribute to your performance need to be handled carefully to not choke them off and sell too early. And probably many of you have sold a stock that went on and doubled and tripled. And if this is you, hopefully these tips will be helpful. So if you do get a significant cushion, around 40% plus, and the market environment is trending and strong, and the stock looks to have a lot more runway, focus on the trend and not so much on the day-to-day movements. I'll talk about what exactly that means in just a minute. And this is because we can get scared out of our best stocks, our biggest winners that go on and double or more from there, simply because of 1 to 3 day sharp pullbacks that simply recover and keep moving higher. There's many instances during this Reddit trend where we pull back for 4 days, recover, pull back, recover, pull back, recover, and keep going until it really breaks trend here. And this started all the way down here, very strong action all the way until we actually meaningfully broke, a trend line, the moving average, the 50 SMA, whatever your definition of trend is. There are a lot of sharp pullbacks in here that could have shaken you out and allowed you to, miss out on all these profits and gains to be gained by getting out at the proper points as it's actually breaking down into a downtrend from being in an uptrend. And one really good tip that Rye actually taught me a few years ago is when you've got a stock like this, where maybe you entered right here, which is actually where I entered, and you get a gap up, you've got a really strong profit, you add more, you've got a nice position, very strong position in this name. When you've got a great profit all the way from down here, you want to think of your profit more in terms of the trailing 21 EMA versus what the stock is doing on a day-to-day fluctuation. And the reason why this is important is because, the changes in P&L from here to here are pretty significant, but you've got a great cost basis. The stock is still acting fine. It's above a rising 21 EMA, above a rising 50 SMA. And this fluctuation doesn't really matter because in a sense it's noise. As long as the stock is above a rising 21 EMA, it's in a healthy trend. And you want to give it the benefit of the doubt, especially if you have a great cushion. So watching versus the 21 EMA smooths out kind of how you're perceiving your profit in that position and allows you mentally to stay with that trend a little bit longer until it meaningfully breaks down and begins a trend below that 21 EMA to end that trade for you. So again, if the stock is trending above a rising 10, 21 EMA and 50 SMA, it is healthy. Let it do its thing. Let it work. And this is really important. Big winners can double or more while never breaking their 21 EMA. I think Tesla went up several 100% without breaking the 21 EMA back in 2020. NIO went up like 500% without breaking the 21 EMA. This moving average will keep you in the strongest stocks. And instead of trying to micromanage everything and try to be perfect, sell up here, buy back here, just letting that 21 EMA do the work will help you both mentally as well as financially profit from that trend a little bit longer. Then another way to stick with the trend a little bit longer, and let me know in the chat, this is actually my question for the day, to win a signed book. what stock is this? This is a guppy chart. These are moving averages. What stock is this? Let me see who gets it here, and you'll win the signed copy of the Trader's Handbook. So let me know your thoughts here. But GMMA charts are basically, they eliminate the day-to-day fluctuations by only showing the moving averages. So we've got some short-term moving averages in red, and longer-term moving averages in blue here. We've got trader EMAs with the short-term, and investor moving averages are the longer-term in blue. And you're looking for a red, white, blue pattern. This was taught to me by Dr. Eric Wish. This is a great thing that he taught to us. Basically, if you're in a red, white, blue pattern with red moving averages with some white space above a blue, there's nothing to be done if you're in that stock in with a good profit. You just want to let it work until it actually breaks down into a red below white, a blue, white, red pattern. Until that happens, there's nothing too much to be done. And even here, it's more just basing versus actually breaking down into a blue, white, red pattern. So again, if red is above white space above blue, and you've got a strong profit, let a stock work and let the trend work and do its thing. But once we meaningfully break down, and this is where it started to break down here, this is where you want to be more selling and just be looking to take profits as we break into a blue, white, red pattern, the inverse of this strong trend here. And let's see who got it here. We've got a lot of PLTR guesses, Netflix. All right, awesome. It looks like Reynaldo got it. This is NVIDIA. This is the start of its move back in 2023. And this is the recent action as it's basing and pulling back and starting a potential stage 4. So Reynaldo, send me a DM on Twitter and we'll get you hooked up with a free copy of the Trader's Handbook. Awesome. Great stuff, guys. All right, cool. So these GMMA charts I think are really powerful. I think a great exercise for everybody watching right now to do is, plot out a stock that you feel like you should have done a lot better in. Look at your entry. Plot it on a guppy chart, and if it's way back here, just look at where you would have sold if you just used the moving averages and waited for a blue, white, red pattern to develop, and see what profit you would have gotten versus what you actually got, and see if this system, this process using these guppy charts once you're at a great profit could help you stay with a winner longer. Another variation, of course, is also to use just a weekly chart and focus more on the weekly action once you've got a great profit. And this is a key point I want to emphasize, and this is something that Jim Ropel really emphasized to me, is to capture a monster winner of 200% or more, you'll need to sit through 1 to 2 bases at least within a strong stage 2 uptrend. And you're going to have to, stick through multiple earnings reports. Some of them may gap down on you, but in order to get a monster winner, you need to, understand where your cost basis is, your profit cushion, what you're willing to give back off the table in order to sit through and get that longer term move. So there's sacrifices that have to be made. If you're an active investor, a position trader, a swing trader, there's always pros and cons to both. And part of the cons of position trading is it's going to take quite a while, and you're going to have to sit through bases, consolidations, earnings reports, which add risk in order to profit potentially from a monster winner, which I know probably many of you had a really good. Reynaldo, shoot me an email at richard@traderlion.com and we'll get you set up. So that's richard@traderlion.com. So yeah, in order to sit through a monster trend like this and get really strong profits on app or a similar name, you have to sit through bases and sit through earnings reports. All right. So here are some good quotes for position traders / active investors. This is from Jesse Livermore. It was never my thinking that made the big money for me. It was always my sitting. Got that? My sitting tight. It is no trick to be right on the market. You always find lots of early bulls in bull markets and early bears in bear markets. I know many men who were right at exactly the right time. I began buying or selling stocks when prices were at the very level which should show the greatest profit. And their experience invariably matched mine. That is, they made no real money out of it. Men who can both be right and sit tight are uncommon. And that's from Jesse Livermore. And what he means by that is, even if you bought correctly here, the ability to sit through this trend as the stock is working from you is very tough. And that's why we need to have rules that say, I won't sell until we break below the 50 SMA, or I won't sell until we break below and start a blue, white, red pattern. These rules protect us and allow us to profit from these monster winners. So that's really important to remember. Then for more active traders, I've got one from Darvis here. As to my basic strategy, I decided I would always do this. I would just jog along with an upward trend, trailing my stop loss insurance behind me. As the trend continued, I would buy more. When the trend reversed, I would run like a thief. So again, active traders, more swing traders, it's a different perspective. You're more trying to just participate when the momentum is strongest and get out of the way, run like a thief when that momentum ends and we start breaking down a little bit, or even, in this environment, you can sell to strength and just trail the rest and wait for the stock to really break down for that last remainder of the position. All right. So now we'll get into selling to strength rules, selling into weakness rules, and what the hell does extended mean and how do we define it? So let me take a quick pause here and see if there's any questions. All right, I don't see any, so perfect. Okay, so selling into strength. Selling into strength means selling a stock as it is rising, becoming extended and volatile, or it's simply meeting profit target levels that you might set at 10%, your average gain, 3R, 5R, 10R, whatever your rule is, that's what selling into strength means. Selling as the stock is rising and meets those criteria. And selling into strength is more suited towards swing trading, and its focus is on locking down profits after quick moves, momentum moves. And the benefit of this is it reduces equity curve drawdowns because you're selling as the stock is rising, although it does increase trading and you're basically required to go and rotate that money into a new idea, a new momentum move. And the bad thing about this and the difficult part and the art of it is that extensions are a judgment call. That's why there's so many questions about, what does extended mean? And you can define extended based on a visual extension. This is how William O'Neill did it after looking at millions of charts, I'm sure, by the time he retired. But you can do it on a visual extension. How far extended are we above a moving average compared to we have been in the past? Just kind of make a judgment call. All right, we're about this far. Previously we only got this far. All right, we're a little bit extended here. You can also define it more objectively based on an ATR from a moving average or a percentage amount from a moving average. Rule of thumb is 10% above the 10 EMA, 20% above the 21 EMA, and 50% above the 50 SMA, 100% or more above the 200 SMA. Those are just rules of thumbs. And it's going to depend on the character of the stock, of course. And you can also base it on relative measured extension. This is an indicator that we developed in DeepView to actually objectively measure extension. And I'll show you that in the examples in just a second. So this can be a really simple and effective way to say this is extended based on prior price action. You can also use key reversal bars. We'll talk about exactly what those are. Failed breakouts are also time to sell to strength. When we try to break out of a base and fail, that can be an early warning sign to get out of the way. And then gap ups after powerful moves. But I want to be very careful here. Gap ups after powerful moves, when a stock has already been trending for quite some time, it's extended in its move, it's extended within its stage 2 uptrend, and the gap is more likely to be exhaustive than a sign that there's a lot of demand, renewed demand from institutions. Gap ups early in a trend are a very strong positive sign, but later in the trend, they can be more exhaustive and more likely should be sold into than accumulated on. And that being said, even for early stage gap ups, swing traders likely are selling into those because, again, their goal is to simply rotate capital out of the powerful movers into the next opportunity. And gap ups are a gift in their minds and allow them to get a profit very quickly. So even for swing traders, early gap ups are likely to be sells or spots to sell to strength, as you see in this diagram. And I think this is a really good rule of thumb as well. If you're thinking about, should I sell? I don't know if I should sell it. I'm up 30%. Should I sell? Should I hold? Look at where the 21 EMA is, which kind of defines the trend for your time frame. So use the relevant moving average, the 50 SMA, the 10 EMA even. And if you're not able to stomach a pullback of your position to that key moving average, it's a good idea to sell a partial. So if visually you expect or think about if the stock pulled back next week all the way to the 21 EMA, which defines what an uptrend is for me, if you can't stomach that pullback, which might be 10%, 20%, and really diminishes your profit on the position while stock is still in an uptrend, that's a good point to sell 25%, sell a third, sell half, so you can stomach that pullback, that natural pullback within the context of that uptrend. And Mickey asks, please repeat the percentage points of extended above the moving averages. Yeah, so this is just a rule of thumb from the 10 EMA, about 10 to 15% above that is extended. Again, higher ADR stocks can go a lot bigger than that. From the 21 EMA, about 20 to 30%, depending on the stock's character. From the 50 SMA, 50%. From the 200 SMA, a double, 100% above that is considered a little bit extended. But again, these are all judgments, and there's always art and the character of the stock to take into account as you're defining what is extended. And that's where relative measured extension kind of comes into play to actually give you a framework that's objective to interpret extensions on all stocks the same way. All right, so what the hell are key reversal bars? Let's get into that. So key reversal bar is when an extended stock gaps up or has a powerful move higher and then reverses even harder and closes well off highs, likely undercutting the prior day's low and maybe even multiple days low. And you can see in this case, and let me know what stock this is. There's no prize, but just I want to see if there's anybody who can get it. During this move, there are many gap ups. It's gapping up almost every day. It looks extended almost every day. It's pretty volatile. And this day is just kind of at the end of this exhaustive phase. So let me know what stock this is. I want to see if there's anybody who gets it. Meta, AMD, nope, not SMCI. There we go. Saeed got it. MSTR. This is MSTR, guys. So this is a key reversal bar when we have a gap up or initial move higher and then an extremely negative reversal down, breaking the high, breaking the close, breaking the low, breaking multiple days lows. This is the type of bar that we're looking out for, because this could be a sign to sell some into weakness, but it's more closer to highs than waiting for a break below the 21 EMA. So there's going to be an early sell signal for position traders, or the last bit that you take off as a swing trader. So these periods, these key reversal bars often lead to the start of a pullback or a basing period, and that's really important. And most significant, these are most significant after a stock has already been trending for multiple weeks and or is showing signs of climactic type action, multiple gap ups, many green days in a row, increasing volatility, increasing slope of the move. So if you visualize a slope, this is the rate of ascent, and then it kind of increases this way. And often these days are the largest range bar in the move and on very high volume as well. So these are bars that you want to look out for. And once you kind of start looking for them, you'll see them all the time as the stock is topping, as the stock is starting to base out, and we'll show a few examples later on as well. So this is MSTR. This was the zoomed in view that I just showed. This is the key reversal bar. And you can see throughout this move, it really respects the 10 EMA here. It's a faster moving stock, so the 10 EMA is kind of the moving average that I would consider for this name. And within that, there's a lot of points where it gets visually extended from that 10 EMA. If you look at how far it kind of gets from 10 EMA, this kind of matches it or exceeds it. This kind of matches it or exceeds it. And each time it does that, it pulls back for a few days and even undercuts the 10 EMA. And these drops look small, but in reality, they're like 10, 15% moves. So you don't really want to be sitting with that type of move in a full position. And this would be the buy point as it gaps above it at 50 SMA, forms this tight flag inside day and breaks higher. That would be the buy point we're using in this case. And these pullbacks are something to avoid it, or just you want to sell into these extensions. And again, visually extended, definitely bigger than this and this as well. Strong bar though, it holds up. You've got a key reversal bar here, but it actually recovers, holds, and gets even more extended. And again, look at the distance, the air from the 10 EMA compared to back here during the normal trend. This is a clear sign that we're getting extended. We get a fade off highs, and you might want to be taking some off every single one of these days, every single one of these extensions. Even though it's not the top, you might want to be taking some off. So then when we do get the pullback, significant pullback from the key reversal bar, you're able to handle that a little bit more objectively because you're not focused on how much money you're losing in the moment. And this is the key reversal bar. This starts the basing process, which it's still been in for quite some time now. And we'll see if it does recover and set back up again. But again, this key reversal bar could be your last sell as a swing trader, or just a warning sign to sell half as a position trader. And down here, we've got the deep view relative measured extension indicator. Anytime it gets in this red area, we're getting a little bit, short-term extended from the 10 EMA. I'm using the 10 simple moving average here with the 50-day look back period. And that is kind of what the indicator is trained on. It's looking at the moving average as well as the past 50 days and how extended we've gotten from that moving average. So anytime we get into this red zone, it might be a time to take profits back here as well. And that's how you can use this indicator. We've done a whole webinar simply on RME. So I'll kind of link that below as well and take a look at that if you're curious about this indicator here. Here's an example with Tesla. This obeys more the 21 EMA. So that's why I'm using the 20 20 SMA with RME. And again, we're getting extended in this area as we're gapping up. A lot of gap ups, definitely extended. This would be where you're selling some into strength. And then we get a key reversal bar here, breaking all these lows all at once. And this starts a basing process before it sets up again and went on another nice move. But this key reversal bar and recognizing that allows you to protect yourself from this gap a little bit. Maybe you're still selling a little bit, but maybe not your whole position. And this further pullback all the way from 270 up here, all the way down to 180, almost 100 points here. You'd be able to hopefully protect yourself and sell earlier to protect yourself from this decline here by recognizing this key reversal bar. And this would be the entry, range breakout, upside reversal to prime the setup, strong push through that pivot level, and you get a gap up, a little bit short-term extended. Swing traders would be selling likely into this day as well, and then maybe selling the final piece as it breaks, prior day lows right here on the key reversal bar. So that is another example with Tesla. Here is Reddit. You get an entry on the 50 SMA reclaim or the entry right here on the flag breakout, and we get an extension here. But remember, this is also a powerful earnings gap, and this is a new stock. So this is kind of more recent and newer within the stage 2 uptrend. So maybe you wouldn't be selling as a position trader into strength here, but a swing trader definitely likely is selling some into strength. You've got another extension here as well. There's a gap up that was sold after a 25% move. And this would be a sign to take a little bit of profit as a swing trader. Again, gap ups are gifts if in a stock that's already short-term extended. And you get another gift here, strong, powerful move up. I think this is also with an analyst price target here. So that's another sign that the gap might not hold. And we pull back afterward. We get another extension, volatility, and this actually starts a base here for a few weeks here. So again, these extensions, as a swing trader, you'll be looking to sell into them. As a position trader, you want to be aware of them and recognize where a stock within its life cycle. Maybe you're not selling early extensions as a position trader, but you might be selling very extreme ones or later in the trend just to lock in some profits and weather a pullback to the 21 EMA or the 50 SMA. All right, then we'll get into selling into weakness here. All right, selling into weakness. Selling into weakness obviously is selling as the stock is breaking trend or showing weak or abnormal price action. And for this, the mindset is we're focusing on riding the trend until it really confirms that it is breaking down and starting a downtrend. And this is going to lead to larger drawdowns off equity highs, but potentially greater reward because you're sticking with that longer term trend until it ends. While selling into strength, you might exit here, here, or here. Here, you're participating in this longer term trend, however long it lasts, until it actually breaks down. Signs of weakness that you want to be watching out for: closes below key moving averages, breaks below trend lines that you can draw at key lows here, breaks below key lows. So, this is a key low here. We broke below it instead of basing above it. We broke below this low right here as well. Large gap downs. So off the top, if there's a failed breakout and then very large gap down on earnings, that could be a sell signal. Reconfirmations of lower highs. So here's a lower high. We reconfirmed down. That would be a sell signal as well. Short-term moving averages curling down and acting as resistance. That's also what happens when we're starting a corrective down period in the market. And let's dive into some examples here. So here's Reddit. Here's the base that started here. We get a nice further move up from this base. But then what happens? Right here, you can see we broke out of a pivot, moved higher, and then started pulling back and gap down and close below this level. So this is a subtle thing that, more advanced traders will see, is this reconfirmation failed. And even though we're pulling back to the 21 EMA, we've got a gap down that tried to rally through that pivot again, but couldn't close higher. And then we leak lower the next few days. So this is the first sign of weakness. Then we get two closes below the 21 EMA. That might be your sell rule as well. Then we get a bad close below the 50 SMA, base breakout fails. This breakout here, this broke out back in this area, fails, another negative sign. The 21 EMA is curling down here. We form a range here. It can't rally higher into the 21 EMA. You can see a lot of wicks up here, and it tries to move higher, reconfirm down, break below the range, gap down, gap down. Gap downs are key, guys. You want to be watching out for these gap downs, and if they can be filled quickly and recovered quickly, that might kind of heal things. But if they can't be healed, it might lead to a lot further downside. And then here decisively, we're trending below a decline 21 and 50 SMA. So this is kind of the topping phase here, and some signs of weakness that you want to be looking out for: failed breakouts, failed pivot reclaims, breaking below moving averages, and all this that we note here on the chart. All right, here is TDD. You've got a nice uptrend here. We break below the trend line as well as the 50 SMA in this case, but also even before that, this is a little bit of a consolidation. We get a breakout. The expectation is we go higher. Instead, we can't, fall through to the upside. We kind of stagnate at the pivot. We leak lower, and then we get a bad break of the 21 EMA. This would be definitely a sell signal here. Then we break below the trend line as well as 50 SMA, start to leak lower. The 50 SMA acts as resistance multiple times, and then we get very large gap down. So if you're not out by this, which you definitely should be as a swing trader and even a position trader, we're below the 50 SMA at this point. You definitely want to exit here. And I think this has declined about 50% since this very large gap down on very large volume. So all these warning signs are things you want to watch out for to protect yourself before further weakness happens and before a stage 4 downtrend really takes hold. Here is GEV, and this is something I want to talk about: large gap downs. This is something probably a lot of people experienced recently with DeepSeek. NVIDIA got hit, GEV got hit, VST got hit. A lot of the high-flying names, which were the leaders, got hit pretty hard. So let's talk about, this large gap down. We'll talk about how to handle them later on. But here's the entry range breakout, strong trend, and then we get the catalyst out of nowhere, DeepSeek, game-changing news, and this is basically a sell. Even though it rallies, it is abnormal action that changes the dynamic of supply and demand. So even if you hold and rally, these likely you want to be sold into. And basically, if you bought a mean reversion trade here, you want to be more biased towards selling into strength, because this gap takes time to heal, often months to heal, this type of thing, if it does. And here you can see it can't break out. It breaks below the range, breaks below 21 EMA, breaking down, and starts a downtrend and is basing out now. But we'll see. We'll have to see what happens with this name. But this large gap down is something you want to look out for, because like with TTD, these large gap downs could just be the start of major declines. And again, the goal at the end of the day is capital preservation. And these gap downs are abnormal action that you don't know if it's going to rally or if it's going to fall through to the downside. And we have to manage risk in real time as traders. And if our reason for buying is that it was moving higher and breaking out of a consolidation, when it pulls back right to our entry point and gaps down to that level, we don't know what's going to happen. It could break these lows and just, fall through to the downside. We have to manage risk in real time with the information we have available and not hope. We have to follow our rules and exit accordingly. All right. Here's the next one. We've got Teladoc back in 2021. This is one I actually bought right here and sold into strength here. We've got a nice rally up above the 21 EMA. Then we have a downside reversal. It can't break out from this consolidation. We get reconfirmation down, another sell signal, a bad break of the 21 EMA all in one bar. We get a gap down. Again, gap downs are key. We have another gap down, lose at the 50 SMA, lose the 200 SMA. So if you're not out by this point, you haven't been paying attention. Really, if you're not out by this point, you haven't been paying attention. And then this starts a major decline. I think it dropped 80% from this level or even more. And throughout that decline, it couldn't rally above the moving averages. It was below declining 50 and 200 SMAs. There are a lot of sell signals here that you could have kind of picked up on to sell into strength as well as into weakness and protect your capital if you did enter from this point, or even are an investor and a long-term investor at that. Here's one more example. We've got NVIDIA, and I want to include this because it's more of a normal type correction in a leader than something that's completely breaking down like the other ones. We've got a nice strong trend. We get a key reversal bar. Again, these are a sign that often basing is needed. We get a lower high. This is another sell signal or warning sign to be looking out for. and we can see we try to form a range here, but instead of breaking out and reconfirming through this high, we break lower. And that's a sign that more correction is coming. And again, we try to firm up, try to move higher, we break lower, downside reversal, and all of that will hopefully protect you and get you out as a swing trader or position trader before the really bad break of the 50 SMA. And then the stock kind of firms up because the best leaders will, need these bases to set up for the next leg higher. I think this rose about 60, 70%, from these levels here. And from this extension down, there's no fall through lower. Then we start forming higher lows. So the opposite of these lower highs, and firm up again and start a new uptrend. But again, as swing traders, we want to be selling into strength here, selling into strength at the lower high. Position traders, breaks below the 50 SMA very badly, sell into that, and then wait for it to set up again and restart a new uptrend. That's the goal that we're trying to participate during the momentum moves, the natural trends versus the corrective bases right here. All right, so I'm going to pause here and see if there's any questions on selling into strength, selling into weakness, as well as defining extensions, because I think that is a key thing that people likely have questions here. So let's see if there's any questions. Shall we think about volume strength as well as just MVA? I think just MA there, that's what you mean. But basically, price is the ultimate deciding factor. It's the most important thing. Volume often confirms and emphasizes key price and volume characteristics, but price is enough to make decisions by, because that's what's defined by supply and demand. So I think price is the most important. Volume can help confirm what you were thinking. Does this work for weekly or hourly charts? It works on all time frames, but we're really focused here as swing and position traders for growth stocks, and we're thinking more about daily and weekly time frames. So it does work on all time frames. There's cycles of price action on all time frames, but there's a lot more noise on intraday charts, and weekly charts might not be the right position management time frame for you, especially if you're a swing trader. So we're focused more on daily charts here and daily characteristics, but these characteristics you want to look out for on all time frames. Let's see here. I use the 5 EMA to measure extension sometimes. Perfect. Yeah, Ethan, that's great, especially for faster swing traders. Instead of a 10 EMA, look for a visual extension or percentage from or ATR from the 5 EMA. That can be a great way to measure extension, especially in the really fast movers. 5 EMA is probably better than 10 EMA. When I'm thinking about extensions, I'm always thinking about the character of the stock, the ADR of the stock, and MSTR is a much faster mover than even a Tesla or Reddit. So I want to be using a 10 EMA versus my normal 20 EMA, 21 EMA. So think about what moving average makes sense. What moving average has been respected in the past? Does it consistently pull back to? And then you could plug that into RME or just look visually and see, are we extended from that moving average compared to where we normally are? So that's, again, a way to define extension is use the moving average that matters to the stock and then look for visual extensions from that moving average. All right, let's see here. All right, when I get stopped out and want to buy back, my broker raises my break-even price due to tax reasons. How do you avoid this? So I treat every trade as a new trade with the new cost basis. Everything for doing stuff for tax purposes isn't the way to go for performance and isn't the right way to think about things. You want to re-enter a stock because it sets back up and there's potential for a new trade opportunity. That's kind of the end of it. And then taxes will kind of take care of itself when it's the time to do that. All right. Parabolic moves like the quantum stocks recently exhibited. Yep. So again, accelerated rates of ascent. This is the rate of ascent, and then it kind of changes right here. That's another sign that we're getting extended, and you might be selling into strength here. You never know what the top date exactly is going to be until we get that really key reversal bar. But you don't want to participate too much and draw down too much, but you do want to participate. So you could sell a little bit into strength, maybe, 25%, 25%, 25%, 25%. Keep doing that and participating with the trend until we get a significant break here. Can we use anchor VWAP? Yeah, you 100% can. For sell rules, I don't think it's quite as effective for me personally. That's how I interpret things. I like using it at the tops of bases or from key days like earnings reports as kind of a line in the sand to determine where, how supply and demand, who's in control, buyers versus sellers, but you could place it versus this day right here, or from a key pivot level. And if that's helpful for you on pullbacks, definitely go ahead and use it. All right. Is there a tool to find these signals automatically and get notifications? We'll be building that into DeepView. You'll be able to add a conditional alert when RMV gets up to 100, give me a notification. When we are 10% above the 10 EMA, give me a notification. We'll be building that in, but right now I don't know of a tool that does that. All right. Great. I think we can move on here. So special situations. These are just kind of key things to think about as well when it comes to position management. First, earnings reports. Earnings reports obviously are a binary event. A stock can gap up 10%. It can pull back 10%. You don't know, there's no way to tell, even if the news is supposedly good, the market can react negatively to that. And it's really about the reaction versus the news that really matters. So you don't want to go in and gamble. That's the main thing. You don't want to just hope that we're going to get a gap up. So the guideline that we have is your profit cushion must be larger than the implied move based on earnings to hold any of your position through. And you can look up implied move various places. We'll be adding it to DeepView pretty soon. But basically, if your profit cushion is 10% and the implied move is 8%, it's right on that edge of, do I have to sell something? Do I have to sell 50%? Do I sell my whole position? Because I don't want to go from 10% profit to only up 2%. That's giving back a lot. And yeah, there could be a point where you're up 10% and then it gaps up and you're up 20%, but you always have to think of the downside more than the upside. And I think as swing traders specifically, you should be biased to selling at least some before earnings, because earnings are such a binary event that it kind of ruins your edge of just kind of rotating through momentum setups to hold through earnings, because it's such a binary event. You could be up big, you could be down big. So I think swing traders should be biased to sell before earnings. Position traders must have a really good cushion, as I mentioned, to have a reason to believe the stock has more runway. It's early in a stage 2. It's part of a very strong trend. Earnings growth has been really strong the recent quarter. And then you could be justified in holding through earnings. But, earnings reports, you always have to think about, am I willing to stomach a gap down of 15% or more after this earnings report? Can I handle that based on my profit cushion? If not, you have to sell some. And I think this is really important. You can always sell half of your position and look to add back on the next setup, because think about this. If the emotions are at play here is fear of missing out right here. So if you don't hold through earnings, it gaps up without you, you're going to feel terrible because you're not participating in the trend when you had the stock. But you can kind of cure that by thinking about, I'll sell half, and then if it gaps up, I'll buy on the earnings gap, or I'll buy on the pivot breakout after the earnings gap. I'll just re-enter that 50% position once, it sets up again, because it will set up again. If it's going to double from the earnings gap, it's going to set up at least a few more times. So you can always sell half of your position and look to add back what you sold on the next low risk setup. So don't feel like you're missing out on anything because you sell some before earnings. In fact, you're kind of protecting yourself because, if it gaps down, maybe you're only losing 4% of your profit versus 8%, 10%. And that's a big difference psychologically and financially based after selling half. So this is kind of how to handle earnings reports, is think about what your profit cushion is. Think about your time frame. Are you a swing trader or position trader? Think about the potential of the stock. And then also, I didn't mention this on the slide, but I should have. Think about the market environment. Has the market environment been really good? Are breakouts working? Are earnings, gapping up all over the place? If not, and things are gapping down, then it's probably a risk-off environment. And even if the stock blows out earnings, it might get sold off anyway. So that's something else to take into account and might bias you towards selling and protecting you when it's a risk-off environment overall. All right, gap downs. We talked about this a little bit in the risk management webinar as well, but gap downs will happen based on unforeseen events. We saw it with DeepSeek. It might be that the stock pre-announces before earnings. Gap downs will happen in some of the names that you are owning. And even in the strongest stocks and the strongest markets, based on news catalysts, there's going to be gap downs of 5%, 10%. Maybe they announce a secondary after hours. That could be a reason for a gap down in a recent IPO. So here's kind of how to think about handling it. On small gaps in a strong market, if you've got cushion in the stock, you should look to give the stock the benefit of the doubt. But of course, always obey your worst case stop loss. So if it's gapping down below the 50 SMA and you're going from 20% profit to 2% profit, that's not really a small gap down actually. So think about what your profit cushion is and take that into account in deciding, are you going to give the stock the benefit of the doubt? And in a strong trending environment, gap downs, in bull markets, gap downs are bought up. You want to see that. If it doesn't happen, that could be a sign to sell, close to the close, and lower your position size overall. But small gaps in a strong market, the main thing here is you want to give them the benefit of the doubt to stick with the trend if you have a strong cushion. However, very large gap downs are kind of a different beast altogether. It's much more abnormal action. So you have to manage risk in real time. Again, if you're going from 40% profit to 5% profit, likely something is wrong with the stock and there's a supply and demand imbalance that even if the stock recovers in the short term, it's likely going to start maybe a downtrend in the future. So always think about managing risk in real time, protecting your capital above all else. And you can always sell first and buy back on the next setup if it does set back up again. But a very large gap down, the money that you had is gone. You have to think about the current situation and if that stock is the best potential candidate for your hard-earned money, and basically make the decision: should I sell, move on, or do I still believe in the stock? I always, if there's a very large gap down, my bias is to selling very shortly after the open, maybe giving it a chance to rally on a 5-minute, but if it doesn't, I'm very quick to cut back. So that's kind of how I personally handle large gap down situations. Then another question that likely many of you are wondering when it comes to position management is, do you use end of day stops? Do you have stops in with your broker, or do you use mental stops? I always personally have a stop in with my broker. I trail that below the 21 EMA, a few percentage points below the 21 EMA. And then I have alert set on the 21 EMA, higher lows, all of that. So I'm always aware if a stock is starting to break down, or potentially showing signs of breaking trend. And personally, in terms of end of day stops versus, acting in the moment, I think, again, it depends on the market. In a very strong market that's rewarding breakouts, that's maybe just after a bear market or significant correction, and things are acting well, you want to give the stock the benefit of the doubt, because sometimes we'll have shakeouts intraday and the stock just recovers and even goes higher into the end of the day, and you're out of your position. You need to buy it back at a higher price. So personally, if it doesn't hit my worst case stop, I want to wait until the last hour, last 30 minutes to make a decision about whether I should sell or not. And yeah, this is basically what I'm saying here. Ideally wait till the last hour if possible, but in a weak market, in a negative market, I sell first, ask questions later. If a stock is breaking down, it could get very, very ugly very, very fast, especially for below the 50 SMA, below the 200 SMA. We've seen some very significant declines in, blue chip companies, and things can get very bad very fast in bad markets. So in bad markets, it's completely different. I will, sell as soon as it hits my stop, or even before that, to protect my capital. Again, during a negative market, risk off environment, defense first, and sell first, ask questions later. Things are guilty until proven innocent in bad markets, and innocent until proven guilty in good markets. And just in general, from a style perspective, swing traders should act faster. Again, you're just trying to turn over your edge, while position traders can give it a little bit more time, see if it recovers end of day or even the next day, and give the stock look to give the stock a benefit of the doubt. And here over on the right hand side, I have one of my mistakes that I made in 2020. I'll go ahead and zoom in here. This was a DocuSign. This is actually from the model book section of chapter 12, guys, from the handbook. So a little sneak preview for you guys. We have a positive expectation breaker. I didn't even see these back then. I didn't know what to look for. But now that you know what a positive expectation breaker is, you'll see these all the time before stocks break out. But I entered really nicely right through the pivot of this breakout, the short range here, right here. It trended beautifully above the 21 EMA. You can see a downside reversal above the 21 EMA, still acting fine, recovers and acts well. But I sold maybe the low tick of this day here as it was breaking the 21 EMA. I had my stop right there. We were in a strong bull market right here. Things were acting well. I think I was up 40%. I mean, this is 87 to about 136 here at this point, 120. So I had a very nice profit in this stock, but I sold as it broke below 21 EMA, and then by the end of the day, it recovered really strongly and then just went up and I think made another 50% move from this point. And this could have really changed my performance that year to make it even better. So this was a mistake that I made. In a strong market, I sold way too early before giving the stock the benefit of the day, benefit of the doubt, and seeing if it closed well, and it did, and just kept on going, respected the 21 EMA, and even here is a sharp pullback to the 21 EMA, closes well, and just keeps on going. So this is a good example of when you're in a strong market, try to give the stock the benefit of the doubt and see if it can recover. And if it keeps on moving down and you've got your worst case stop, definitely protect yourself. But try to wait until that last hour to make a decision if possible. All right. So getting more into the summary here, and hopefully this has been helpful to you guys. Here are some kind of overall key steps for business management. First, once at a profit, know your rules for moving up stops. Again, we talked about risk management a lot more in the previous webinar. Watch for sells into strength if that's your style. If applicable, look for add reentry points if you're more stage 3, stage 4. Watch for sells into weakness that define the end of the trend. And then if you do end up exiting all the stock, don't just kick out the stock and never revisit it. Add the stock back to a watch list and see if it sets up again, sets up a new base, and sets up a new opportunity. Often the best stocks to trade are ones you've already traded and had a lot of success with. That's another golden nugget for you guys. So here are some key takeaways that I want you to have from today's webinar. First, define rules that match your stage and trading style, whether you're a swing trader or day trader or position trader, active investor, whether you're a stage 1 trader or much further along, stage 3, stage 4. Know the pros and cons of selling into strength versus weakness. We talked about those, the opportunity costs, the needing to find a new trade versus, potentially getting a 300, 400, 500% plus move. Then you want to define rules for yourself for selling into strength. Be as objective as possible. Define what extended means to you. Is that a percentage above a moving average? Is it ADR above a moving average? Is it using relative measured extension from deep view? Pick a rule and define it so somebody else could say, could follow that rule and say, looking at the chart exactly the same way as you, yes, that is extended. That's the clarity and the amount of clarity that you want to have in your rules. In the same way, define rules for selling into weakness. Is it 2 closes below a moving average? Is it a break of a trend line? How do you draw that trend line? Define that in your rules so another trader of a similar experience level could follow it exactly as you do. Then this is really key. Sell rules allow you to manage a position with clarity, with a framework to try to manage those emotions and have an understanding of exactly your objective and what you're trying to do. And then lastly, I discussed this a few times, different market environments will favor faster or slower sell rules. And you don't want to overfit your rules to one market type of environment because you want it to be robust and work in all market environments. And then one more key takeaway I want to add here is, again, your sell rule should reflect your experience level in the markets and where you're at. If you're very new at this, in your first year, 2, 3 years even, the goal is consistency and process and being very rigid with your sell rules versus later on when you've got more experience, you're much more, adept at things, at managing risk, all of that, recognizing shifts in the market. At that point, you can be a little bit more creative, a little bit more, discretionary in your choices. Do I sell at this extension or do I wait for the next one? At that point, you've earned the right to be more fluid with your sell rules. But early on, you want to be a lot more rigid and build that consistency, build that technique up, and that gives you the skills to then be more flexible later on. All right. So that's it for today's webinar. Hopefully this has been really helpful for you guys. Hopefully the examples applying the different variations of sell rules helped you as well. And I just want to say again, if you find these webinars helpful, a great way to thank us and also get more resources is to go ahead and order the Trader's Handbook. You can do that by scanning this QR code. If you're enjoying these webinars, you're going to love this book. And even if you're a very advanced trader, the model book there is definitely worth reviewing to study those greatest winners. And if you're a very new trader, this handbook could really make the difference in helping you build a system, become profitable, become consistent, and learn the blueprint for trading success. So again, definitely go ahead and order yours if you haven't already. But thank you guys all for attending. I'll answer a few questions here. All right. Yeah, and on DocuSign, I did not start a new position after I got shaken out. Again, another mistake here. All right. Darnell asks, can you tell us about the stochastic indicator? To me, is the best indicator to buy, sell, combined with trend lines 2050 200 SMA. Yeah, the stochastic is great. I think any indicator can work well. And Dr. Wish uses the stochastic, and I used it for many years. Any indicator can work really well. It's basically just a momentum indicator, but you have to study it, see when it works, when it doesn't work, test it for yourself. And it can be a great way to buy pullbacks, strength after pullbacks. So use it for yourself and define rules that another trader could follow using the same methodology. All right. All right. Let's see here. There's no formula for the extension indicator. It's proprietary. You can use it in deep view. Highly recommend doing it. It's something that I developed myself. All right. Scott says, love the webinar, pre-ordered book. Looking forward to learning more. Awesome. Thank you so much, Scott. Appreciate it. A lot of thank yous. Thank you guys so much. Glad this has been helpful, guys. Thank you so much. All right. Yeah, and again, this will be released on May 27th, but you can pre-order right now at Amazon, Barnes & Noble, anywhere. And that way you'll get it as soon as it's out. So thank you guys so much for attending. Yeah, thank you so much. We look forward to seeing you in the future webinars. Definitely go ahead and pick up your book if you haven't already. And yeah, we'll have this recording up as soon as possible. So thank you guys all for attending. If you did enjoy, please go ahead and leave a like down below. Subscribe if you're new to the channel. And if you're able to share it on Twitter, share with friends. If you find this to be valuable, go ahead and share this webinar with anybody you can. So thanks so much again for spending some of your Saturday with me. Definitely appreciate it. And I'll see you guys in future videos. Take care.